Now, we may get word today that the recession is over when the government finally releases third quarter GDP at 8:30 a.m. One-time items like cash for clunkers will contribute to the growth. So joining us now to preview today's data and offer us a look ahead is Rob Carnell. He is chief economist at ING Financial Markets in London. Good morning, sir. Thank you for joining us. We've got the headline number, and people are saying we're looking for 3% growth, possibly a 4 handle. What about the quality of that data? That's a concern here, isn't it?
Yeah, it is. I don't think, and obviously you don't buy economies and you don't buy GDP data, but if you were buying the stock market, I think you would want to see something a little bigger than, or a little better in quality terms than just a huge inventory swing or consumption which is purely premised on a one-off cash for clunkers car stimulus program. And you know, the thing about this number is whatever it comes out as, I think those inventory numbers, those completely unforecastable figures, are probably going to be at the heart of any figure or any surprise we get today.
Now, you in your note said that inventory figures would be depressing. Can you explain why?
Well, it's depressing when you're trying to forecast them. I mean, we have to operate from the basis of the available data, and the available data, unfortunately, very rarely matches up with the inventory data that's published with the GDP numbers. So if you're trying to get the number right and you've got all the other components right, and then inventories comes along and kind of kicks you in the teeth with some massive surprise, that's a little bit depressing. You get the number wrong professionally, it's not very helpful. It's also depressing because you really want to see sustainable domestic demand pickup, not just inventory growth. Inventory growth's fine and all well and good, and it's part of every upswing and every business recovery cycle. But it only lasts a number of quarters. Once you've done your readjustment, your restocking, that's it. Then you need the proper consumption to come in, the investment side to come in, and that's where we have some doubts over the sustainability. No one, I think, expects this sort of figure. You know, we get 3 or 4% today to be sustained into the fourth quarter.
Now, if fourth quarter GDP is looking to come in negative, like a lot of people expect, could we see the really strong third quarter number signal a bigger drop-off in the fourth quarter and subsequent quarters?
I think the fourth quarter is really very much dependent on what happens this quarter. It's going to be one of those that what the market should be doing is looking through the third and the fourth quarter and drawing a straight line between the two. If we get a superbly strong number today and probably premised on some inventory swing, then the likelihood is that the fourth quarter will be equally soft on the way out. So I think that's the way to look at it.
All right. Thank you so much. Rob Carnell, Chief International Economist at ING Financial Markets in London.